Did you know a single Roth conversion mistake could accidentally increase your annual Medicare premiums by over $2,000? A Roth conversion is one of the most powerful tax planning tools for your retirement. You move money from a pre-tax account, like a 401k or traditional IRA, into a post-tax Roth IRA. You pay the income tax now, but in exchange, you get potentially decades of tax-free growth and, more importantly, completely tax-free withdrawals in retirement. This can save you a fortune, especially if you believe tax rates are likely to rise in the future. It's a strategic move to trade a known tax bill today for an unknown, but potentially much larger tax bill tomorrow. But here's the catch the IRS has buried in the tax code. The conversion itself is a taxable event. The amount you convert is added directly to your ordinary income for the year. This isn't capital gains, it's treated just like a salary. And because of this, a simple, well-intentioned decision can trigger a cascade of unintended financial consequences. It's not a simple transfer. It's a transaction with the IRS, and they've set up a minefield of complex rules that are incredibly easy to get wrong, turning a smart move into a five-figure blunder. In this video, we are not just talking about minor slip-ups. We are dissecting the 7 critical Roth conversion mistakes that can easily cost you $10,000 or more. We'll break down the obscure pro-rata rule, the confusing 5-year clocks, the dreaded Medicare IRMAA cliff, and the simple timing errors that can decimate your savings. By the end, you will understand how to navigate this process like a professional, ensuring your conversion is a strategic masterpiece, not a financial disaster. Let's get started. The first major trap is the tax bracket explosion. The core strategy of a successful conversion is tax bracket management. You want to convert just enough money each year to fill up your current lower tax bracket without spilling over into a much higher one. For instance, if you have $40,000 of room left in the 24% bracket, you might convert exactly that amount. The mistake is thinking you should convert your entire IRA at once. This creates a massive artificial spike in your income for 1 year, potentially pushing you from the 12% or 22% bracket all the way into the 35% or 37% bracket. You end up paying a huge portion of your conversion at the highest marginal rates, defeating the entire purpose of tax planning. This is especially dangerous because of the tax bomb lurking in your traditional IRA. If you have a large pre-tax balance, say $500,000 or more, you are sitting on a future tax liability. When you reach the age for required minimum distributions, or RMDs, the government forces you to withdraw a certain percentage each year, and that withdrawal is fully taxable. As you get older and your account potentially grows, these RMDs can become so large they push you into higher tax brackets anyway, at a time in your life when you least want the financial stress. The Roth conversion is supposed to diffuse this bomb by paying taxes on your own terms, in lower tax years, before the RMDs force your hand. The second, and perhaps most misunderstood, trap is the pro-rata rule. Many people think they can make a non-deductible after-tax contribution to a traditional IRA and then immediately convert just that specific contribution to a Roth tax-free. This is often called a backdoor Roth IRA, but the IRS says no. The pro-rata rule states that for tax purposes, the IRS views all of your traditional SEP and simple IRAs as one single giant account. They don't care which account the money came from. They look at the total balance of all these accounts and calculate the ratio of pre-tax money to after-tax money. Your conversion is then taxed according to that ratio. Let's put numbers to this to see the damage. Imagine you have a $100,000 rollover IRA from an old 401k, which is all pre-tax money. You hear about the backdoor Roth and contribute $7,000 in after-tax money to a new traditional IRA. Your plan is to convert that $7,000 tax-free. But the IRS sees your total IRA balance is $107,000. Of that total, only 6.5% is after-tax money. Therefore, when you convert $7,000, the IRS deems that only 6.5% of it, or $455, is a tax-free return of your contribution. The other 93.5%, or $6,545, is considered a conversion of pre-tax earnings and is fully taxable as income. You expected a zero tax bill and instead got one on over $6,000. The third major landmine is the confusing set of 5-year rules. There are actually 2 separate rules, and people constantly mix them up. The first rule applies to all Roth IRAs. It states that you must wait 5 years from your very first contribution to any Roth IRA before you can withdraw earnings tax-free and penalty-free, assuming you are also over age 59 and a half. This clock starts on January 1st of the year you made your first contribution. So if you contributed for the first time in 2025, your 5-year period is satisfied on January 1st, 2030. This rule is about earnings, not your own contributions, which you can always withdraw. But the second 5-year rule is the one that bites converters. Each Roth conversion you make has its own separate 5-year holding period. This rule is designed to prevent you from using a Roth conversion to get around the 10% early withdrawal penalty. If you are under age 59 and a half and you withdraw converted principal within 5 years of that specific conversion, you will be hit with a 10% penalty. So, if you convert $50,000 in 2026 and another $50,000 in 2027, each of those amounts has its own clock. Withdrawing $20,000 in 2030 would be penalty-free from the 2026 conversion, but not from the 2027 conversion. It's a logistical nightmare that can trigger surprise penalties years down the road. The fourth mistake is perhaps the most financially devastating for retirees, triggering the IRMAA cliff. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge that high-income retirees must pay on their Medicare Part B and Part D premiums. The critical thing to understand is that the income used to calculate this surcharge is your modified adjusted gross income, or MAGI, from 2 years prior. And guess what adds directly to your MAGI? A Roth conversion. A large conversion can easily push your income over the IRMAA thresholds, triggering thousands of dollars in extra healthcare costs. The cliff aspect of IRMAA is what makes it so dangerous. The income thresholds are not gradual. If your income goes over a threshold by just one single dollar, you are hit with the full surcharge for the next tier up. For a married couple, crossing the first major threshold could cost each spouse over $1,000 more in annual premiums. A large, unplanned conversion can easily bump you up several tiers, potentially costing your household $4,000, $5,000, or even $6,000 in extra Medicare premiums 2 years down the road. It's a massive delayed penalty for a single year of poor tax planning. The fifth mistake is a simple but costly procedural error: paying the conversion tax from the wrong account. When you convert $100,000, you will owe income tax on that amount. Let's say it's $24,000. The ideal way to pay this tax is with money from a separate non-retirement account, like a savings or brokerage account. The mistake is asking your IRA custodian to withhold the $24,000 from the conversion amount and send it to the IRS for you. While convenient, this is a terrible idea for 2 reasons. First, the $24,000 never makes it to your Roth IRA, meaning it loses out on a lifetime of tax-free growth. Second, if you are under 59 and a half, the IRS views that $24,000 withholding as an early distribution, which means it's subject to an additional 10% penalty. That's a $2,400 penalty on top of the tax you already owed. Now, let's see these mistakes in action with a few case studies. Meet a retiree who falls into the pro-rata trap. He has a $490,000 rollover IRA from an old 401k, all of it pre-tax. He wants to start a Roth IRA, So he makes a $10,000 non-deductible contribution to a new traditional IRA. His plan is to immediately convert that $10,000, which he believes should be tax-free. But when his accountant runs the numbers, the IRS sees one big $500,000 IRA. Of that total, only 2%, $10,000, is after-tax money. Therefore, 98% of his $10,000 conversion is taxable. Instead of a tax-free move, he gets a surprise tax bill on $9,800 of income he never expected. Next, consider the IRMAA cliff. A retired couple has a comfortable income of $200,000 from pensions and Social Security. They decide to be proactive and convert $50,000 from a traditional IRA to a Roth. This pushes their income for the year to $250,000. They pay the income tax and think they're done. But 2 years later, they get a notice from the Social Security Administration. Their income from 2 years ago has pushed them over the IRMAA threshold. Their monthly Medicare Part B premiums are suddenly hundreds of dollars higher for each of them. For the entire year, they end up paying over $3,000 in additional health care premiums, a costly side effect they never saw coming. Here's a case of the 5-year penalty. A 55-year-old decides to get a head start on her Roth strategy. In 2026, she converts $100,000 from her 401k to a new Roth IRA. She pays the taxes and feels good about the move. 3 years later, in 2029, a major home repair is needed, and she needs to pull $20,000 from her savings. She sees the large balance in her Roth IRA and decides to take it from there, assuming it's her money. But because she is under 59 and a half, and she has not met the 5-year holding period for that specific 2026 conversion, the withdrawal is subject to a 10% penalty. She ends up paying a $2,000 penalty to the IRS for accessing her own money a couple of years too early. Let's look at the 6th mistake. The state tax surprise. Imagine you live in a high-income tax state like California or New York. You're 63 and plan to retire in 2 years to a state with no income tax, like Florida or Texas. You decide to do a large $200,000 Roth conversion now while you're still working. You calculate the federal tax, but you also get hit with a hefty state income tax bill, which could be an extra $20,000 or more. Had you simply waited 2 years until after you moved, you could have done the exact same conversion and completely avoided that state tax bill. The timing of your conversion relative to your residency can have a massive impact on the total cost. Finally, the 7th mistake is a critical timing error for older retirees, forgetting the RMD. Once you are of RMD age, you must take your required minimum distribution from your traditional IRA for the year. Before, you can convert any funds from that IRA to a Roth. The IRS considers the very first dollars to come out of your IRA in an RMD year to be the satisfaction of that RMD. RMDs themselves are not eligible to be converted. So if a 75-year-old tries to convert $50,000 in December but has not yet taken their RMD for the year, the transaction can get messy. The IRS may deem part of the conversion to be the RMD, which would make it a taxable distribution but not a valid conversion, leading to paperwork headaches and potential excess contribution penalties. Now that we've seen the traps, let's dismantle some of the most common and dangerous misconceptions about Roth conversions. The first is the belief that any Roth conversion is a good thing. This is simply not true. A conversion is fundamentally a bet on your future tax rate. It only makes sense if you believe you will be in the same or a higher tax bracket in retirement when you withdraw the money. If you do a large conversion during your peak earning years at a 32% tax rate, but you expect your retirement income to be low enough to fall into the 12% bracket, you've made a costly error. You've voluntarily paid taxes at a much higher rate than you needed to. The second huge misconception is, I can just convert my after-tax IRA contributions. As we covered with the pro-rata rule, this is the mistake that fuels the backdoor Roth IRA trap. The IRS does not allow you to cherry-pick which dollars you convert. You cannot isolate your non-deductible contributions and convert only them. The taxability of your conversion is determined by the blend of pre-tax and after-tax dollars across the aggregate of all your non-Roth IRA accounts. You can't unscramble the egg. Once you have both pre-tax and after-tax money mixed together in any of your IRAs, any conversion will be partially taxable. A third common point of confusion is believing the 5-year rule clock starts when I open my first Roth IRA. This is only partially true and dangerously incomplete. That single clock, which starts on January 1st of your first contribution year, applies only to accessing earnings, tax-free, after age 59 and a half. What people miss is that each conversion starts its own separate 5-year clock for a different purpose, avoiding the 10% penalty on withdrawals of converted principal before you reach age 59 and a half. You could have a Roth IRA for 20 years, but a new conversion you made last year is still subject to this penalty if you touch it before its specific 5-year period is up. Finally, a deadly deadline mistake, thinking, I have until April 15th to do a conversion for last year. This is a classic mix-up with the IRA contribution deadline. You can indeed contribute to an IRA for the previous year up until tax day. However, a Roth conversion must be completed by December 31st of the tax year you want it to count for. You absolutely cannot do a 2025 conversion in March of 2026. This mistake can ruin a multi-year conversion strategy, as you might miss the window to convert in a low-income year, forcing you to wait until the next tax year when your income, and thus your tax rate on the conversion, might be significantly higher. Understanding these intricate rules transforms a Roth conversion from a financial gamble into a precision instrument for wealth preservation.